Welcome to the Wealth Consulting Group's halftime outlook. As you can see on the slide here, we've got three faces of which we've got Jim Worden, our Chief Investment Officer, on with us, and Talley Leger, our Chief Market Strategist. For all of our clients who probably don't know who Paisley Nardini is, she's a certified financial analyst and a consultant to our investment committee. She's the managing director at a company called Simplify, but she participates with our investment committee regularly. She's also a co-host of a podcast that we have. We bring her on as a special co-host from time to time. Our podcast is for financial advisors, but it's okay if you find it and look at it. It's called The Bull of Wall Street. It's on Spotify, Apple, YouTube. And we have great guests on that show. We have a lot of the leading chief economists, analysts, money managers, and other types of people, mainly for financial advisors' interest. But it's something that we're active in. The goal for today's meeting is to give you a review of where we've been this year so far as investors and clients. And on behalf of all the advisors that we support that are affiliated with the Wealth Consulting Group, we support their businesses. And from behind the scenes, we're their back office partner when it comes to the portfolio management for a lot of your accounts and portfolios. And so beyond reviewing what have gone through for the first half of the year, we want to give you an outlook as to what we think, what we may see in the economy and the markets in the second half of the year. So this first slide is an interesting one. I want to ask Tally, because he put this slide together, about it a little bit and the title of it. So Tally, why don't you go ahead?
Yeah. Well, I can't take full credit because we did leverage our new artificial intelligence or AI analysts to help generate this one based on our themes. But our mid-year outlook, Jimmy, has a title, and you can see that it's inspired by the Choose Your Own Adventure novels from the 1960s that I inherited from my older brothers. I'm a 1970s baby, so is Jim. So I guess you're the big brother in this one, Jimmy. Sorry to call you out.
All
But
right.
the whole point of this is, and we'll get to this in coming slides, but we can play with all the major moving parts, and we'll describe each one in turn and how we can choose a whole series or a range of outcomes to get to or take a path higher on the S&P 500. And so this mid-year does a few things. We're actually laying out the framework that we employ to kind of give us a directional steer that kind of guides and informs the investment strategy committee's directional views and portfolio positioning.
Thanks, Tally. And just to give everybody a background of who Tally is, Tally, when I met him, was one of the executives at Invesco, a multi-trillion dollar asset manager. And he would do a lot of talks on stage to firms like ours, to financial advisors, to retail clients of advisors as well. And that's where we developed a relationship. I thought he was phenomenal in his approach and how he looked at the markets. And you'll see both Tally and Jim Worden on a lot of the financial media, whether it's CNBC, Fox Business, you name it, Bloomberg, BBC, BNN, a lot of financial media. So they're on TV a lot. They're in financial publications. But Tally's a respected, analyst and macro economist to his own right on a lot of things. So if we can go to the next slide.
Yeah. And, I also want to add that I think it was John Maynard Keynes who said it's better to be roughly right instead of precisely wrong. So we're not necessarily trying to nail a bullseye here. We want to get the direction of the market right. So
And
take it
before I
away.
introduce Jim a little bit, who's going to talk about this slide that he came up with, we're proud of the performance in our client accounts for the portfolios that we manage, from the investment committee perspective. we've had a very interesting and volatile first half of the year. We started out with some pretty robust returns, and then comes February, and then the whole Liberation Day with tariffs and a lot of volatility in April. Intraday, we went into what the industry calls is a bear market. So we didn't technically close, I don't think, under 20%, but the S&P 500 was down, intraday 20%, which is a big move. And then since then, we've had an incredible, incredible recovery, I think historic in terms of how fast the rebound has been. The good news is that we were positioned really, really great in all of our models and strategies for that. We're at the bottom of the market. We weren't down nearly as much as on our equity accounts and portfolios as what the market was at that time. And we've done very well in terms of a comeback. We've participated a lot. A lot of that's due to the work that's being done on the investment committee. It's not a one-person show, but as our chief investment officer, Jim Worden, leads the process for us. And so Jim created the site. So Jim, talk to us a little bit about what this represents.
Yeah, thanks, Jimmy. Good to be with everyone. So this slide, I think in my mind, and this was also AI generated, I wanted to kind of get a feel of Wizard of Oz and the house is spinning around. Dorothy's getting worried about what's going to happen. We all kind of felt this way during April with tariffs, and this is our bull. We were bullish back then, and we stayed bullish amidst this vortex that you see here. And we believe that not only did the bull land, but like we were still optimistic during that period, and even now we're even more optimistic.
All right. It's a cool visual, I think. Let's move the presentation forward, Tally.
Sure.
So I'm going to try
So,
to serve as a little bit of a moderator and get us through, I believe, around 25 slides. We're on page 3 here. So
mhm.
I'm gonna as these slides come up, ask Jim and Tally to explain what's going on. But I think Tally, to start out, so that to send a message of what we think may happen for the rest of the year, we're pretty bullish, right? As we saw the bull in that last slide, we're pretty constructive
Yeah.
where we think the economy and the markets are going, and I think that a lot of this presentation is geared around the reasons why. So, Tally, if you
Mhm.
want to give kind of a big picture view of that and then get into the slide, be great.
Yeah, so I'll kind of drive straight to the punchline, which is actually the very last slide in the deck. So as Jimmy said to us, we're gonna kind of tell you what we're gonna tell you. We're gonna tell you, and then we're gonna tell you again. So it's not crazy, and this is for the gut check, but it wouldn't be unusual to get a third year of double-digit gains on the stock market. And I'm not going to get into why, but history is on our side on that score. So that's kind of the, in a nutshell, view that we're embracing here at WCG. But when it comes to the important questions that we're going to try and answer for you as clients on the call here, we break it down into 4 key levels, okay? And this is, again, this is our very kind of straightforward process or framework when we're trying to get our arms around the outlook for stocks. And it really starts, number one, with sales. That's the top line or dollar revenue outlook for the S&P 500. So you can think of that like widgets being produced at the widget factory. We're trying to count them, and we're trying to kind of take the current pulse and see where we might go 6 to 12 months from here, if that makes sense. So that's the top line. Number two is margins. And we're gonna dig into that in more detail. But what is a margin? It is very simply your earnings, your bottom line, divided by your top line expressed in percentage terms. And that number right now happens to be 12% on the S&P 500. And we're going to show this in coming slide, but the margin is your swing factor for the bottom line. So you project sales, you apply margin, and that gets you down all the way down to the bottom line. And that's earnings number 3 in the framework here. Okay. So we kind of play around, and this is I guess, the art of interactive storytelling at its finest. We'll show you how we do it. we play around with those margin assumptions to see how sensitive earnings are to those changes. They're highly sensitive, so I'll let the cat out of the bag there. And then we talk about the price to earnings ratio, the PE multiple for short. And that gets to, well, what would you pay as an investor for those dollars of earnings? What's the right kind of multiple or ratio in the current stage of the market cycle? Does that make sense, Jimmy?
Yeah, I think it makes a lot of sense. And if you want to forward to the next slide, if that makes sense, to talk more about that. So as we look at this slide, I want to bring it back a little bit in terms of our process at the firm. So our investment committee, which is more than just the three of us and Paisley, we have other members of that committee that work at the Wealth Consulting Group, supporting all of the, again, independent advisors that we support out there, working with all of you as clients and investors. We meet weekly, normally about 50 times a year, and it's quite often cadence, and there's a lot of research. So not only do we have a lot of our internal resources, we also purchase a lot of industry best of class industry research out there. So we buy a lot of that stuff. We own different types of software. We spend a lot of money on it. On top of that, every single quarter, and even more often than that, we were looking at a report that one of our asset management partners went through this morning on our investment committee call. But we look at or have our portfolios reviewed by some of the best money managers out there in the world that in some cases are managing, in many cases, managing trillions and trillions of dollars. And we have their experts take a look at our models and our positions and tell us what they think. Our job at the firm and on the investment committees to take those ideas and then implement them into actionable, ideas that are inside a client portfolio, so that while the advisor is meeting with our clients and we can do a lot of the work in the back office, doing the research and trading that it takes to manage portfolios. That being said, Talley, I think this is one that you wanted to talk about, and this is a great, phrase that I think you came up with that I've heard you say before. But go ahead.
Well, so I read a great post from Jim on this. He wrote a very nice and succinct first half review. So I'd like to share this one with him. But basically, what you can see on the left side of this chart, this is just a simple first and second quarter performance chart across a series of categories that we felt would matter to our advisors and you, their clients. And you can see that in the first quarter here, and this is basically a perfect illustration of how bad the Sell American trade got and how far down the Magnificent Seven and the NASDAQ and small caps fell in that time frame. But then we did a complete about face, and we were vindicated. Like the performance ratified our bullishness, and those kind of dark blue bars in the southern hemisphere flipped up to the light blue bars in the northern hemisphere. And so investors very strongly pivoted to the Buy American trade. And so we were talking about April showers bringing May flowers at the time, and that worked very well for us. But Jim, jump in here, would you?
Yeah, so I was just going to add to this. I mean, this is showing quarter over quarter. So we showed the first quarter, we showed the second quarter. I think it's really important to note that we reached highs in the markets in mid-February, and from there things got really ugly in March and particularly April. And so while it shows that the S&P 500 is down 4% in the first quarter, which is true, that drawdown was really, really close to 20%. We didn't quite get there, and this is why we had the tornado with the bull. It felt like a really rough period. If you look at volatility, we're not showing volatility on this chart, but you can see some of these have really flipped. The more volatile indices, and certainly the Mag 7, which had some volatility there, big swings. And this is not swings from the February highs, this is swings from one quarter to the next. And so I think that's just important to note that big changes happen with the markets. Now, fundamentally, we didn't see a lot of catalysts for big changes other than talking about tariffs and saying there's going to be big tariffs. That was the only thing that did all of this. So we remain constructive on the fundamentals. The technicals appeared very oversold. And so we saw this as a period that, hey, we just need to stick with it, hang in there. The bull is going to land.
Can I add, because it keys nicely off what you just said, Jim, in our January outlook for the year, we said tactical defense, strategic offense, which was spot on, not to toot our own horns, but I'm going to do it anyway. We also said don't overstay your welcome in defensive assets, and that includes government bonds. And you lightened up, Jim. I'm going to kind of praise you on this one as well, on what we call duration, meaning you stayed away from the longer dated or longer maturity government bonds, right, in the portfolios.
Yes, we did. It was not me. It was a team effort, Tally, but we did, and a lot of that was due to just the lack of demand for the longer part of the yield curve. We just saw there was too much volatility. We weren't comfortable with that amount of risk, and so we shortened it. That certainly helped our portfolios.
Good call.
All right, let's move forward.
Yeah.
Are we stuck? There we go. So this is an interesting one, right? I think Tally can talk more about this. We're going to try to get through all the slides pretty quickly, and I know there's a few obviously big subjects that every investor is thinking about. It used to be inflation. I think inflation is still a thing, right? Tariffs. There's some slides on all these subjects. And will the Fed cut or not? I think we're going to get to all of those things. But in a lot of cases, it pays to be contrarian to how people are feeling. Tally, talk to us about that.
Yeah. I mean, I can hit this one pretty quickly. So you guys know at our conference, this was Collaborate back in late April. Yeah, I think it was late April,
Early April.
Was it early April?
Yeah.
So we started talking about reasons to buy the dips, and I published for us on our behalf. I put this report together. It went out in early April. It was 8 reasons to buy the dips in stocks. Now, as a strategist, the timing doesn't get, for me personally, doesn't get any better than that. It was a few trading days early, but that's about as good as I'm going to get. But this slide, if you look at the bottom panel, combines 7 of those 8 concepts into one indicator. I can't get too technical around it, but it's an oscillator. So you can see the mean is stationary. It's very stable. But what we had back then in the dark days of April, that was the low in the stock market. You can trace the dotted line here. We had what we call, I don't know if you're familiar with your Greek letters and the Greek alphabet, but we had what we call a -3 sigma event, which is a very large standard deviation event. And you can see since 1996, we've only had 3 others of its kind. And they coincided with other big bottoms in stocks around some massive market dislocations. You can see them here in the tech bubble of 2001 and 09. That was the global financial crisis and Great Recession of that time, as well as 2020. That was the Great Lockdown, if you will. So that really stood out to us, and we said, from a statistical perspective, sentiment and positioning got too bearish. And the fundamentals, we're going to talk about that in coming slides, but the fundamentals at the time were still very stable. So we thought this is really a compelling buying opportunity. So we've got to zig when others are zagging. And I'll give you a little preview here. When you apply the average 12-month forward return from these three prior events, it's 30%, which implies 6,500 or more by the end of this year. And I worry, and I said this to Jim, that might not be bullish enough.
That's great. And so a lot of times I think what's important for investors to understand is that when the consensus is to panic or to be afraid, that a lot of times it's best to look the other way. And but just not saying that, but looking at the data that our investment committee, our team is looking at it. Hopefully, that's what you're going to see as clients and investors. That there's a lot of information that's supporting our views, and it's just not somebody's opinion. So this is another interesting slide. I don't know who wants to take this one, but and by the
Here you
way,
go.
for the audience here, I've tried to communicate to our two professionals that are very smart analytical people to try to lack of better words, dumb this presentation down as much as possible in the language. So we're trying to use words that we hope that most investors can understand more than what financial analysts or financial advisors can see. So with that in mind, if somebody wants to take this, go ahead.
Yeah, I'll take it, Tally. So I love the slide. It's kind of fun because we got our pictures on there. We got different viewpoints. And by the way, on our investment committees, we value very much diversity of thought. And so, if I turn bearish tomorrow, hopefully, Tally and Jimmy, they're still going to be my friends, right? So, and if they turn bearish, it's the same thing. So none of us are bearish here. We all are constructive on what's happening with the market, but you see here, Paisley is not as bullish. She's a pragmatist. She doesn't see from where we're at now that we can have a big return. Tally's kind of here in the middle. He's bullish, and I'm on the far right, and I'm a raging bull. And so, you can see that this distribution, this skewness, it shows that the markets are not perfectly distributed. And I'm trying to make this, sound, clear. But like the outcomes are different, and over time they're going to be different. There's going to be periods where we don't always see eye to eye, but we respect each other and we listen to one another. And so that makes me feel more comfortable, by the way, when I, hear what Tally's saying with the things that he likes, and he hears the things that I like about the market. And then Jimmy hears both of those. And then, it makes us have a little bit more conviction. If it weren't that way, we would probably be a little bit more cautious.
And I think,
Yeah.
what I was going to say is I think it's important that we also, and you pointed out today in today's call, we had a report from one of the largest asset managers that we reviewed today, looking at our models and looking at other people's inputs and opinions about the way they see things is to us very important, and taking that outside information so it's not groupthink within our own house. And so again, just trying to reiterate the process that we go through. But the reality is that our firm has especially during the times in April when things were really ugly and a lot of people were reassessing, a lot of professionals were reassessing what their projections were for the end of the year. I can tell you that our team was confident in what we were thinking was going to happen, and we're very fortunate that so far, anyways, that's played out. So, Tally, we can move on to the next slide.
Sure. So before I do, I'll pass along something that my statistics professor, who was an MIT guy, did to help us learn this kind of bell curve or normal distribution. He called it a sombrero, which it always stuck with me. I hope it sticks with you. But if you can envision turning the sombrero on its left side, and you can see the bottom panel, that is the distribution of these kind of returns or outcomes over time. And if you look on the far right hand side, there is plenty of room for sentiment and positioning to have more of a positive outcome or right skew. We call it a fat tail, if you will. And so there's plenty of fuel left to drive this market higher, potentially significantly so. And that gets us to sales. So this gets us right back to number one in the framework and the questions that we're trying to disentangle for you all on the call. Jimmy, should I just jump into this one?
Yeah, please. And yeah.
So this kind of gets to the point that the economy is the number one important driver for the stock market, but maybe not in the way that you think. In fact, when it comes to the odds of a recession, it's the opposite. It's the mirror image. And so this is borne out in the data. So the dark blue area or mountain chart here, that's the S&P 500 on the left scale. And this thinner light blue line, that's the odds of recession in 2025. And so you can see here, it was really difficult and understandable not to, for the bulls amongst us to get swept up into that swirling vortex of negativity and fears about a recession. So this is the dark days of April. Market bottomed on a closing basis on April 8th, and that was basically the peak in fear and concerns about recession. So it took a lot of discipline on our parts not to get swept up in that. In fact, like we've been saying, we did the opposite. We encouraged our customers to buy the dips in stocks. Lo and behold, we didn't look back. That was the right call. And now, if you fast forward, recession odds have come down to 20% or less. And again, that has ratified our view, and we're back to all-time highs on the S&P 500.
Next slide. This is a good one. I think, in terms of what some of the information that we research and look at to tell us, what, may happen in the future. Talley, you want to get into this a little bit?
Yeah. So there's this organization called the National Bureau of Economic Research, NBER for short, and they're the ones that decide the timing of the peaks and troughs in the business cycle. It's not up to us. I wish it were. But having said that, we do know the six indicators that they look at to make their determinations. So we have an inside track here. And this, again, we do a lot of research on the committee, and I've read the white papers, but these indicators, these six concepts are available from public sources, whether it's the Census Bureau or the Federal Reserve or the Bureau of Labor Statistics. There's a whole host of these free providers. I know where to go to get them. We can combine them, and that's what we did. This is our proprietary, we call it a diffusion index. And all it does is it shows us the percentage of those six indicators that are expanding, that are in the northern hemisphere. So this was really one of our North Stars in our toolkit, if you will. During those dark days of April, we were looking at this indicator and saying, are we seeing a recession in the data yet? No, we're not. And these are hard data. They're not soft data. So I think this is one of the reasons why we kind of avoided getting whipsawed, unlike many of our competitors.
And when Talley says hard data, these are actual, just facts, figures of how the economy is performing with different indicators, where the soft data might be more like how people are feeling, which we know that this is a bull market, gentlemen, that people hate, right? Because there's a lot of experts that were calling it the wrong way. And Jim, the question I've got for you is not just for this year and these indicators that we're looking at for this year, but why was it that the Wealth Consulting Group, did not believe that the economy was going to fall into a recession for the last few years? Because you and I and the rest of us have talked about there's some very prominent people that we respect, that we like. They're chief economists at some of the biggest firms in the world that were just flat out wrong. What do you think? Why is that? Why was that?
Yeah, I think part of it is an anchoring bias where people are kind of, reluctant to change their opinion, to change their views, and to say, well, maybe things aren't that bad. Because if you remember back in 2022, which didn't feel great, that was a rough period of time. A lot of people said, well, 2023 is going to get worse, and it's going to get worse than it, and it just didn't. For us, I think one of the turning points where we said, hey, this has got, the economy has a good footing, was to see earnings revisions higher, was to see sales growth, was to see really, kind of this starting of AI and the AI boom and what was happening behind the scenes, and how it was happening and how it was unfolding, capital expenditures increasing, and then, changes to policy, all of those things. We saw that there was still some headwinds, but we saw there were more tailwinds that could
Mm.
lift the market higher.
Can I ask you a question, Jim? So
Yeah.
you're our in-house technician, and but between the two of us, we're chart guys, right?
Yeah.
So when you look at this chart, we're at 100% now, so 6 out of 6 are growing. Let's flip it on its head. When should we, kind of ring the alarm bell? What would be the signal?
Well, I mean, this is a beautiful chart, and I've seen charts like this before. I think they're super helpful to gauge kind of like where are we going. I mean, you can see those areas that are in gray that are highlighted, recessions. We didn't get anywhere to the 50 number, and so I would say, good rule of thumb is like, let's not even worry about it unless we start getting close to that 50, and then, we can look at portfolio positioning. But we weren't anywhere near there. Most of the time, well, you can see every case here, full blown recessions, it was over 50, well over 50 in some cases. So I think that, looking at that basket of 6 indicators, and just, monitoring that and knowing that, hey, most of these things were still working well, even though
Yep.
it felt painful. It felt like we were in the vortex.
Yeah,
This was another gut check to tell us that, hey, look, things are not as bad as they feel. Things are
that's
not
right.
as bad as they seem.
And I think that there were some historical indicators that signaled recession. For example, like the yield curve inverting as badly as it did. But if you look at that in context of other things like we're talking about here, then overall our assessment and your assessment has been that we weren't going to fall into recession. And so we're actually pretty bullish about the remainder of the year. I've been saying a lot in some of the media that I do. We haven't had interest rates cut yet, as soon as what we thought may happen, but I still think we're going to be in a lower, interest rate environment. And then, the effects of deregulation, I think could be another big tailwind. That being said, if you guys can get into this slide here,
Yeah.
in terms of these
This
other
is a quick
regions
one.
that yeah, are bullish. Go ahead.
Well, so the prior slide, we talk about the frequency of data. That was monthly. This one's even higher frequency. This is on a weekly basis. So this indicator really is a nice complement to the diffusion index that we just showed you. But the whole point here is if you look on the far right-hand side, despite all the hand wringing and the concerns back in the dark days of April, it was still a 2% economy. It remains a 2% economy. And that feels just about right, folks.
Awesome. Next slide.
And this is where we really get into it. Should I just take it away here, Jimmy?
Yes, please.
So, like I was saying earlier, the economy is really the first main kind of cylinder of the engine driving top line growth for the S&P 500. And you don't have to take our word for it. You can just look at the picture on the left hand side, and it doesn't take an advanced degree in statistics to see for yourselves that there has been a very strong directional relationship. We call it a correlation between the economy, that's the dark blue line, and sales per share for the S&P 500. That is the lighter blue line. And what's nice to see here on the right hand side of that left chart is that, and this is the starting point for the whole conversation, we've got a very robust nominal pace of economic activity, around 5%. That is the starting point, underpinning a pretty stable top line growth outlook for the market, which is also about 5%.
All right, next slide.
And when you pull that apart, you can see across the major sectors of the US economy, whether it's manufacturers, wholesalers, retailers, we're in an uptrend. And you can see that we're not making these numbers up. Remember this number, 6%. And if that trajectory were to continue, it would be pretty easy to extrapolate a 7% revenue growth rate.
The trend is your friend.
Yes, that's Marty Zweig, right?
Yep.
Our old
And
mentor.
our goal is to finish right on time by 2, and unfortunately for compliance purposes, we can't take live Q&A, but we will try to get through these next slides. And I think this is really important, right? So if you guys, maybe Jim, you could talk about this, right? We
Sure.
talk about it a lot in terms of AI and the influence of artificial intelligence on the economy, the markets, and how much money the largest companies are spending, and how that's affecting everything else. So I think
Yeah,
we need to
yeah,
talk about this.
happy to do so. And so, Tally did a great job of gathering this data. Chart on the left is looking at Google Trends, people that are looking about AI, how to use AI, how to be more productive. You can see a massive spike there. There are other studies that show how many times they're mentioning it in earnings conference call, and it's just exploded. It's completely exploded. If you look at the chart on the graph on the right, you can actually see it's still mostly information technology tech companies that are really using AI. That's kind of where it was born from. But you can see that there are a number of other industries, a number of other sectors that are starting to benefit from this. And so I think the first wave we see is what's happening with OpenAI and NVIDIA and all that's coming about from that. And then the second wave is other tech firms that are using it. And then it's like, how are healthcare companies using it? How are energy companies using it? Literally every sector you can see here. And these have increased, by the way, from where they were in terms of how to use technology. So we're not overhyping this, but really it is an AI revolution. It's probably bigger than what the internet was when the internet first came out, because there's just so many different applications, not just for people on their phone or on their computer, but if you can, discover new drugs that can cure diseases, if you can ship your goods and distribute them more efficiently and optimally. There are many, many use cases and testing for safety. And, there's some industrial companies that are using it for testing and research. And so it's really just the tip of the iceberg right now. We haven't seen all of that, but
Here's
go
another good
for
one
it.
for you,
Yeah.
Jim.
Want me to take this one too?
Yeah.
Yeah, talk about
Yeah.
margins and how aggressive, how
Yeah.
optimistic it would be to assume that we actually get back to a peak margin here.
Yeah. Yeah. It's a good question. And there are a lot of people that look at this and say, well, how can it just keep growing and growing and growing? Well, we have to take a look at what the market is made up of, right? And so right now, the largest company in the world is NVIDIA. They used to just make video game graphics cards.
That's
And
right.
so now they're the world's largest company. And the reason is because that same technology that allowed them to process video games really well, it is very, very, very effective for doing high compute, high intense calculations for artificial intelligence. And so it's not a stretch. And when a company that big, that's more than $4 trillion in size, when they go from 70% margin to 75 or 78%, you can see that's a big move. You have other companies that are also, leveraging AI and what's happening with technology. And so they can have big moves too. And so that can really pull forward the margins. And so it's not a stretch to get to, 12 and a half, 13% margins for the market. And then you can see, again, the industries that this is just looking at efficiency gains, massive amounts of gains. I think it's interesting here that more efficiency can be gained with real estate than even technology. And that makes a lot of sense. And, as you look at industries, financials would be another one that have lots of paperwork. There's lots of moving pieces and middlemen that are in there. Well, AI is disrupting a lot of that, and it's going to make it more efficient for a lot of these industries.
It's great. So this gets us to earnings in the framework and the outlook there. And so this kind of pairing of charts does a couple things. Number one, it shows you, and this is a quote from Larry Kudlow at Fox. We're regular guests on Fox Business, so we like to kind of invoke that spirit. But the earnings outlook is the mother's milk of stocks. And so you can see the relationship here. This is why we spend so much time trying to get our heads around the kind of bottom line or the earnings pulse of the market. So the dark blue line is the S&P price index, and the light blue line is earnings per share. And you can see that the bottom up analyst community currently expects $255 per share of earnings this year and almost $300 next year. And I'll just tell you, if you're unfamiliar, the analyst community is known for being structurally overly optimistic. But I actually think their numbers are looking pretty reasonable this year. And we're going to get into why. And in fact, I'm an enabler, but I think Jim could be right. We could actually blow past consensus if some of our assumptions are right. So the bottom line here is, if you look on the right hand side, this is the rate of change on the same concept. You can see that a robust pace of earnings growth could potentially underpin this bright outlook we're seeing for stocks.
So the kind of bottom line, that, gentlemen, is that the expectations going forward, even with all the noise we've heard about tariffs, is that companies are going to produce really good growth in profit margins, right? That's the bottom line of this. Go next slide.
Yep. This is a quick hit too. So when you're entering an earnings reporting period, and we did that about a week ago, beginning with the big banks like JP Morgan, you've all heard of. Before that happens, when visibility improves along with confidence and morale, and this is happening, what you see is an increasing number of companies. We call it raising guidance. So we talked about the analysts and their outlook in the previous slide, but the companies themselves also pre-announce and give what we call forward guidance. And you can see that the point here is we have seen this kind of sequential or quarter over quarter improvement in what the companies are saying themselves about their own fundamental outlook. And that's why I like to say, listen to the companies, not the analysts. So there's plenty of room for improvement here.
And I think that's important. Jim, I know you're going to say something, but I think that was a lot of what we were doing during the last 3 or 4 years when people were talking about recession, that the analysts or the economists were maybe predicting recession, but the companies themselves were saying, hey, we're doing okay. And so I think that's important. Go ahead, Jim.
Yeah, no, I agree. The one thing I was just going to add is we look at these numbers every single week, all the companies that are reporting in the S&P 500, and we can gauge to see, are they hitting their numbers? Are they beating their numbers? Sure. Who's getting downgraded? Who's getting upgraded? And just looking at this last week, 88% of them beat their numbers. And
Wow.
those that beat by 8.5%. And so we're seeing
Mm.
that these are second quarter numbers. This is likely going to have a ripple effect to where analysts, if their numbers are beat by that much by the companies, they're going to raise their estimates. And so you kind of sometimes do have this period where analysts have to catch up with what the
Yep.
companies are actually doing.
So that's a good point, and I just put this out internally as a note, and you wouldn't, everyone on the call would know that, but just over the past 4 quarters, we've actually seen earnings come in above analyst
Mhm.
expectations by about 5%. And this quarter, lo and behold, same pattern. Analysts for the second quarter, they're only expecting 5%. So if just by the behavior alone, we could easily get, you add 5 and 5,
Yeah.
10% earnings growth. So I'll advance here. We can keep it moving. So this is another one. I'll hit this very quickly. But this is another, I think, underappreciated tailwind for earnings called company share repurchases or buybacks for short. So what you have is cash-rich companies in the very same sectors that we're talking about. It's usually high quality, growthy, technology-oriented or tech-enabled companies that are buying back their own stock. So what they're doing is reducing their share count and giving kind of a definitional lift to earnings per share, and in the process, returning funds to investors like us. And you can see here that that has been happening at an accelerating pace. In fact, a 24% year over year pace, again, led by technology. And you can see over time there has been a very strong directional relationship between buyback growth and earnings growth. Jim, why don't you take this one? This is the choose your own adventure. Talk to us about the horizontal and the vertical lines here and what it means for
Yeah.
earnings.
Yeah, sure thing. So this is great. So this just shows you remember you saw the picture of Talley, myself, and Paisley, and some different numbers there. So I'm kind of the green there, to the right and to the bottom there, and Talley is kind of right there in the middle. But this is looking at earnings based on sales growth up at the top. So if you track sales growth, if we get a little bit more sales growth, guess what? That translates into better earnings. And if we get a little bit better margins, which is the left-hand side, that also translates into better earnings. And so we believe that while consensus is $255, we may see $275. That's the green area. We do have consensus at 255. But like this is kind of that, again, choose your own adventure. We believe that we're certainly in a good place with profits and sales growth and margins.
And
And
Jim, can
I
you
just want to
explain that?
underscore.
I'm sorry, can you explain that just a little bit? I don't think everybody understands what 275 would mean on the S&P 500 when it comes to dollars of earnings. I think we as people in our business talk about that a lot, but what does that mean for someone listening?
Yeah,
Yeah,
so
that's go ahead.
well,
I
I
was
was just
just
going to say what you do is you take your sales per share, that's this number here, 2109, and you multiply it by your percentage margin assumption of 13, and that gets you to 275. And you can see there's all sorts of different permutations and combinations or ways to get 275 just by playing with your sales growth assumptions and your margin assumptions. So I just want to underscore here 5% sales growth. That's what we have right now. So it's not crazy to assume that things could get a little bit better on the top line. That because that's what we just have right now. We're not
yeah.
making that up. And the margin now, that we're not making that up. The starting point is about 12%. So if we just get a little bit more help by all the efficiencies and AI and the tech investments we're talking about, directionally, it'd be easy for us to get to 255, maybe even more, just with a better margin.
Well, I think this also clearly shows there's multiple paths to get there. You can get there through margins getting a little bit better and cost reductions. You can also
Yep,
get there with better revenue growth.
that's
So,
right.
At the end, everybody, I'm going to ask these two for their opinions on what could make things not so rosy. We'll get there at the end. And just as a reminder, we've got about 8 minutes to finish up the rest of the slides, so we got to move a little bit.
Okay, so PE, very, very simple. This is your price to earnings ratio. Yes, it is above the high end of its historical range, but look, we think that you get what you pay for, and in this case, I would say that U.S. stocks, large cap stocks, deserve a high multiple because of the higher share of rapidly growing, high quality tech enabled companies that we've been talking about. And we're not being crazy. We're not talking about massive P multiple expansion. We're just saying that it can stay at a high level for some of the reasons that we're going to get into.
And then one thing I think is important that's worth the time to talk about outside, when we say Max 7, those are the seven biggest companies in the S&P 500, right?
mhm.
Also more of the technology stocks that are often investing a lot of money in AI. When you look at the rest of the market, though, it's not quite as expensive. And we actually believe that some of those big companies that are spending all the tens of billions of dollars per company on AI potentially should be in their own category with different multiple averages that would be normal, not like the whole historical averages that we've always been taught and thought about for 50, 100 years. So go ahead,
Right.
Tal.
So here's one of the key reasons why we talked about just their market composition. There's another angle from a structure, market structure perspective, but I'll make it very simple. What we have on a trend basis is cooling inflation, and you can see if you flip the PE on its head, you get what's called the earnings yield. So it's just the opposite of the PE. And there's a very nice directional relationship between inflation, that's the dark blue line, and that earnings yield, that's the light blue line, over time. And this one goes back to 1973. This is the span of our lives between Jim and me. And if you look in the far right hand side, you can see uh, what has happened and how this narrative has evolved. For stocks, we had a peak headline consumer price inflation rate of about 9%. And since then, we've calmed back down to something below 3%, we'll call it, to 2.7%. And in turn, that has kind of given a lift and provided a pretty nice tailwind to equity valuations. And we think that force remains in place. And here are a couple of the reasons. I'll hit these very quickly. So again, like Jim said, we like to listen to the earnings conference calls from these companies for some of the important keywords, whether it's AI or recession, or in this case, inflation. And the good news is you can see on the left-hand side that the number of companies citing inflation has been coming down alongside that disinflationary trend, despite all the concerns and hang-ringing about the tariffs and the trade wars. The companies just aren't seeing it from a margin and inflation perspective. And even when you look at what happened to oil prices, despite all the geopolitical conflict that we've seen, man, it's been a wild, crazy first half. But there's plenty of oil price deflation. Well, I just talked about disinflation, that's cooling prices, but deflation would be falling prices in the pipeline, pun intended in this case. So again, we think that helps kind of take the pressure off headline consumer price inflation here. I'll go back. Should we hit the dollar very quickly, Jimmy?
Very quickly, 'cause I think it's important. People are talking about it a lot. The Sell American trade. How do you guys feel about that? I know we had a discussion about that this morning as well.
So over time, I'll cut to the chase. There's a very weak relationship between S&P 500 returns on average over time and changes in our currency. It's almost zero, in fact, since the 1970s. Why? Because of this relationship right here. And it gets down to the impact of the dollar on the two main things we're talking about, the PE ratio that's on the left-hand side and the earnings per share on the right-hand side. So yes, we've on a year-to-date basis, we've seen a bit of a weakening in the currency, quite a notable one, and that probably lowers the ceiling on valuations. That's why we're not kind of getting crazy with our PE multiple assumptions here, because of that kind of downward force of dollar weakness. But on the other side, don't forget, and this is how the math works, it also raises the floor under the earnings outlook, and that supports our optimistic assumptions for fundamentals on that score. And that gets us to this table. Jim, why don't you walk us through this one too?
Yeah, so this one is really just looking at the earnings per share up at the top and looking at the valuation or price to earnings multiple on the left hand side, and this is where we've said before we believe that the S&P 500 could hit 7,000. There's a path to get there. Certainly, you can see that in the green area, but the other areas are not bad. I mean, these are not bad outcomes. I guess, just trying to sum this up real quickly, we think we're very constructive with earnings, and we can talk about the flip side of what can go wrong. But like right now, this gets us where we think investors should be very happy with their returns.
So should we hit seasonals very quickly? Because I think it's timely and topical. So Jim, you actually sent me this series. We have daily data, daily frequency data on the S&P 500 going back to 1928. And what you can do, this is a little kind of technical trick. You can look at the average monthly returns for every month going as far back as 1928, and you can see what the seasonal patterns are. And it's interesting, but we've just entered, and I'm talking about June and July here. We're at or on the leading edge of a pretty favorable seasonal period for stocks. But don't go to the beach too soon, because and you've got to stay alert here, and we're going to help you on that score. September is known for being, on average, one of the weakest months of the year, but don't get too concerned, because that is quickly followed by a nice year-end rally. So what we do very quickly, if we apply the typical pattern to where we closed the first half of the year, again, that gets us to a nice kind of operating baseline assumption of 6,500 with upside risk to 7,000 for the end of the year.
And as we go to the next two slides, we're not promoting market timing. So while historical results may be something, we don't think that people should be betting on that. So go ahead, get us to the finish line here.
Jim, this is your chart.
Yeah, so I mean, we can see here the mean on the chart on the right gets us right around 7,000. That is kind of the path that we discussed at the beginning of the year, and even in the middle of the year. Well, at least in April, we talked about that path is still there. We did go through some difficult times. You can see that very strong V, toward what we went through, and this is kind of that vortex that we went through, and so we're in a good place. We think we can get there. We don't have any crystal balls. Any forecast that you have is going to have a number of assumptions, and so we feel that we did a pretty good job outlining what those assumptions were and how we get there. And we believe there's a number of ways that you can get there. And so that's kind of where we're at. And you can see the chart on the left says, we're still not going to be overvalued if we get to 7,000.
So you just said something I want to chime in on very quickly. You talked about a V. So what we're saying is we hope in the forecasting business, and there's no guarantees, but judging by all the work, that this is going to start looking like a hockey stick. That's the image we're trying to convey. And I want to give, maybe we can land the plane on a famous quote from the great one, Wayne Gretzky. We want to skate to where the puck is going, not to where it has been. And hopefully that's directionally towards 7,000.
I think it's a good last one to end on, and then we can get to the no, you can go to the slide before. I think it's good.
Okay.
Figure that there we go. So I think, Jim, you could say here that there's a chance that we could have a third year in a row, right? If you look at history of bull markets, and that's really what this slide is trying to portray here, that a third year of positive returns, as you guys can see historically, is not unusual in bull markets like this. And before we get to the last slide, which is just a representation of our investment committee, I think we should show the compliance slide at the end. But I do want to ask one question to Jim to finish out, and that is to ask what could go wrong in the projections? What could be the disruptors you think that potentially could upset the forecast that we have? And maybe Tally, if you can get us to the compliance side at the end, be great.
Yeah. So what can go wrong? So if we look at the 1995 to 1999 period, really great performance there. We also had a tech bubble. Some people are comparing what we're going through now to the tech bubble. I think it's certainly possible that we get 5 years in a row of double-digit returns. The key difference now between then is a lot of these companies are very, very profitable. Now, what can go wrong is if we get overbuilt, right? If there's too much going in there and not enough people using it, that's something that is not a concern this year or probably next year, but maybe 2027, 2028. That's going out a couple years. The other things that can go wrong is just we don't know what will happen with the current administration and tariffs and geopolitics. It's really difficult to model.
Mhm.
Are the wars going to get worse? Are they going to get better? So that's something that could get worse. Personally, I believe the biggest concern for me is if things go too well, right? If we have a melt up type of environment and maybe, we blow way past 7,000 on the S&P 500, we hit 8,000, right? So if we just go straight up, then that sets us up to come down significantly if there's too much, froth happening. That is a concern. Another concern is, the labor market continues to weaken. The Fed does nothing. And now all of a sudden, we've got higher unemployment, much higher unemployment, and we have a recession. We think that the odds of that are still low, call it, around 20%, 15 to 20%, but it is something that we have to be aware of.
All right, Tally, if you get us to the last slide, and I'll just wrap up with a summary for all of us. That's just a picture of the investment committee. If you get to the next slide, I think there you go. We can just stop there. And the very last one. So in summary, as you can see, and thanks for sharing with us, Jim, some of the risks that are out there to the forecast that we're putting out. But in summary, we went through a lot of volatility, even during the dark days of April. As an investment committee, Jim and Tally and the rest of the team felt convicted to stay the course and didn't see a recession coming or need to panic or shift allocations significantly in any one way or the other. In fact, we went the other way. I think we added to areas that we thought presented value because of the decline. And as you saw a lot, if you stuck through the whole presentation, there's a lot of information in there, technical information that these gentlemen and the rest of our committee is looking at to support the view that's just not their feelings or opinions on why we're feeling that there's a good chance that we have a great second half of the year. And we know that for clients and for the advisors that are working with you that we support, we know that at the end of the day, that's kind of what you're counting on us for. And our goal is to make sure that you guys are getting the best risk-adjusted returns. And hopefully we're going to be continuing to do our job and work with your advisor to make sure that the messaging around and the communication around what we're doing gets even better. And so for that, thank you very much for your business. We really do appreciate your business. All of us at the Wealth Consulting Group, we understand, that the most important relationships are the ones with our advisors and our clients. So thank you very much. Sarah, I think you can now end the call. And for those of you that stuck around, we really appreciate it. There's, I think, a question in the chat room. We will get back to you guys on that.